model like my brother.
All right.
Sounds good.
So, good morning, everyone, and thanks for joining us. We will have some people popping in. I can see the numbers rising as we start. So good morning and welcome to our LendED Small Business Accounting webinar with the famous Davey Mack. Davey, welcome and congratulations on your recent award.
Oh, thanks very much. It's super humbling just to get an award like that. And it was actually my last year that I could actually get a Young Accountant of the Year. So now I'm 31, so I can't go for that award anymore. So hopefully maybe I can hit the Accountant of the Year award one day. So see how it goes.
Nice work, mate. Nice work. Now you've given your age away to everyone. So thank you all for joining us so much. And today we really wanted to make sure that this particular accounting webinar was really directed to you as our brokers, as our partners, to give you some really insightful tips around how you can start your financial year on track. Now, as per usual, it seems to be the norm at the moment. We have been hijacked yet again by COVID. So we will touch on that this morning, but we'll also be talking about your business, how you can start and then keep on track in relation to your own business. So this one is for you brokers. So Davey, let's start. Can you give us a bit of a run through on the small business grants? We know we had one released a couple of weeks ago. That's now been expanded. So can you just give our partners a run through on what's available now?
Yeah, sure. So basically, right now the grants are more available for New South Wales. So it's state driven right now. The federal government did have a partnership with New South Wales right now, but it looks like New South Wales is running a New South Wales, which is the Service New South Wales association that's running the whole grant. So you have to apply through there. But basically, if you're turning over $75,000 to $50 million, you can demonstrate that you're losing 30% or have a drop in turnover or 30%, then you can apply for a payment of $1,500 up to $10,000 per week. So it's similar to JobKeeper, but I think it's a lot more easier to apply for because in JobKeeper, you're applying and looking at a turnover drop depending on your GST turnover, and that could be monthly, quarterly. But in this case here, it's fortnightly. So they only just want to see a 2-week drop in 30% of turnover and compared to 2019. It doesn't matter if you're a sole trader, you could be a trust, you could be a company or a sole trader, and you can still apply for this grant.
Perfect. And is it the same as last time? Is it just a matter of going to MyGov, or is that more for the employees? How do businesses access the grants or apply?
Yeah, so this one's more specifically for businesses, not the individuals. There's another one for individuals I can jump into later. But yeah, you go in, so not MyGov, you don't go into ATO. It's not managed by the federal government. It's actually managed by the New South Wales state. So there's something called Service New South Wales, which is a website that the New South Wales government manages, and you jump on there, and you can even go into your phone app that we have as well, and you can log on and you can apply through there. Usually what they do is they have like an identification. You have to put in your license details as well, and they identify you through there. Then you put in the company details or the business details. After that, usually during the registration process, because obviously this application hasn't actually came out yet, we're still waiting for another week for it to come out. But I believe that it's going to be a similar case of last year where you apply and you write down, you lodge a accountant's letter to show that there is a 30% drop in turnover. So have a chat to your accountant, make sure that your accountant knows about this and they're ready to rock and roll with checking your turnover and seeing if there's a drop. And then you apply through the Service New South Wales website.
Perfect. Now, for those of you that have joined us today, when you receive your CPD email tomorrow morning, Davey is actually running a webinar tomorrow specifically on these COVID supplements and grants. So we will put that link in there for you. It's 3 o'clock on a Friday, so you can certainly tomorrow. So you can certainly jump on and register through the link that will be in that email tomorrow. But let's get back to our brokers. And the first thing we want to talk about today, Davey, is when should a business change their structure? So we see lots of brokers who start out as sole traders, their book grows, their business grows. Let's talk about business structures and when do we start and when do we change?
Yeah, sure. Sounds great. So this is actually a very common question, whether it's at the start of a business or for a broker or during the middle or at the end as well. They always talk about structuring. It's great because us accountants have something to talk about other than tax. But let me just quickly share my screen and show you guys the options that we advise our brokers on our books. So can everyone see my screen? Can you see my screen?
We can, and don't forget, we definitely can see your screen, Davey. And don't forget, guys, please use the Q&A section if you've got any questions. And at the end of the webinar, we'll be going through those with Davey. So we've already got a couple in already. So keep using that section, and we'll come back to them at the end of the webinar.
Good. Yep, sounds good. You told me about the questions because I can't see the questions, but let me just jump right into the types of structures. So you got a sole trader, you got a company, and you got a trust. They're the most common structures for brokers. And then you got a very complex one, which is option 4. So option 1 and 2 and 3 is the structures that most brokers jump onto. And it doesn't actually, like, there is no one best structure for your situation. It all depends on your how much tax you're paying, how simple you want it, your income level, your asset, and how many assets do you have personally in the business as well and personally, and what your thinking is. Like, are you thinking long term or short term? And then there's also talk about, like, property investments, exit strategy, succession planning. There's a whole bunch of things that you could think about when you're determining your structure. But let me just explain the different structures there are. There's a sole trader, which is basically you're trading in your personal name. And there's a company where you're trading as a separate entity. It's not in your personal name, but it's like corporations, and it's usually named XYZ Pty Limited. That company itself pays taxes itself. It can be sued, it can sue others, and it lodges its own tax return. Whereas a sole trader lodges the tax return under your personal name, and you show your income, your wages, your business income all together in one tax return, whereas a company is separate completely. Then you got a trust, which is kind of like a bit of a hybrid of the two, but it's also very different. If you ask a lawyer, they would say it's completely different, it trades under a separate entity as well. But the thing with a trust is that it can't hold the profits at the end of the day. It always has to distribute the profits to the owners or what they call a beneficiary. So they're the difference in structures. Let's talk about the pros.
Yeah, I was going to say, let's talk about the pros and cons of each one. So if we start with sole trader, talk about the pros and cons of being a sole trader.
Yeah, so sole trader, the pros of that, the main pro is it's cheap, it's easy. And if you're not making much income, you're starting off as a broker because it's a side hustle right now and you're not sure how your income is going to be, your tax rate's going to be quite low because the lower the income, the lower the tax rate in your personal name. So you start off with 0% tax all the way up to about $20,000 in income. And then from $20,000 to $45,000, your tax rate's 19 cents in a dollar. So 19%. That's the lowest tax rate you can get other than superannuation fund. So people that are not sure about their business, they're trying this out about mortgage brokering, they'll rather start up as a sole trader because one, they don't want to inject too much money in it. Two, they don't want to complicate things. And three, their income is quite low. So they don't need to have a complex structure. The cons, on the other hand, of a sole trader is exactly the opposite. It's too simple. So therefore, as a result, if the business gets sued, you personally will be liable for the business's liabilities, debts, and you would have to go to court personally under your name. It exposes you personally as a result, and therefore, if you've got personal assets in your personal name, like a house, car, your creditors or the people suing you can go after that. So, yeah,
so there's no asset protection under a sole trader structure.
Yeah, basically, there is a bit of asset protection. You can get insurance to cover yourself. You're covered by the law, but in the end, if you're found liable, your business is found liable because you're negligent, they go after you personally.
Okay.
Yeah. Cool.
All right. So companies, let's go through the pros and cons of having a company structure.
So the best, so my business is structured under the company. And the reason why I love companies is because the ATO loves companies. So if the ATO loves companies, you follow what the ATO wants you to do because they'll give you a lot of benefits. You'll notice that in the last 2 years, well, especially during COVID, the government gave a lot of grants to companies. And the reason why they do that is because companies are a lot more simple to manage. It's managed by the Corporations Act, like ASIC. It's managed by ATO. So they know that how the tax works in a company. When it comes to trust, for example, we'll go into that. It's very complex, and the ATO and the government have made it clear that they don't like trust. So that's a really, really big pro about companies. Another pro, which is you can tell what the government's doing, is they're reducing the tax rates for companies. So it went from 30%, 5 years ago, now to 25%. 25% is probably one of the lowest tax rates you can get for a business. Sole trader can go up to 45% in taxes, whereas a company is 25% flat. So that's one really, really big pro. And then you've got asset protection because the company and the business is separated from your personal name. So you've got now your house in your personal name, and you've got a business in a company where if something were to happen to the company, it doesn't impact your personal assets. So that's a good thing about them. And it also helps with tax planning because now you've got two separate tax rates, one in your personal name and you've got another tax rate in your company. So very good for tax planning. You can shift income in different entities like yourself and the company. And also it creates a bit of flexibility where you can actually incorporate where you can see option 4, trust in a company. And it's also investor friendly. So a lot of people ask me, why is it investor friendly? It's because you can own shares in a company. You can ask investors to come in, or you can ask a business partner to come in and say, hey, do you want to buy 50% of my business? And then you can do 50-50 and there's a clear split. Whereas in a trust or a sole trader, it's quite hard to do the split. And also it's not governed by the government because ASIC governs the shareholdings, and you can pretty much do a search online to work out who's the owner of the company. So you know that your business partner is not doing anything dodgy or anything like that. It's straight out 50% owned. The government knows that it's 50% owned. And if anything were to happen later on down the track, you just know that you own 50% of the business. Yeah. So that's a good thing about the companies. I didn't actually talk about cons. Hey, I love companies, but there are cons in companies. So cost is sometimes a big problem because anywhere between $600 to $1,000 to set up a company, and then there's accounting costs as well. So there's $2,000 to $3,000 in accounting fees that you have to pay on an annual basis, and on top of that, there's registration fees, which is roughly about $270 a year as well.
So in my lending experience, Davey, I've certainly seen lots of people that have got some sort of strike-off action because they forgot to pay their company fees, and that's the only reason why. Now, look, when we move to trust, I'm going to tongue-in-cheek say that you said that the ATO and the government don't particularly like trust because they're fairly complex. So maybe on this one, let's start on the cons of trust, and then we can finish off on a positive note of the pros.
Sounds good. I did forget something that companies also are not entitled to a CGT discount, which is a 50% discount on your capital gains if you ever sell the business. So that's really a really bad con about companies that actually the brokers don't like, because brokers do sell their loan book or their client base one day, and if you don't get a 50% discount, that means that you might be paying 45% in taxes for your capital gain when you do sell the business. So it's a pretty bad con. That's why leaning towards the trust, it might be a good idea. But let's talk about the cons of a trust. The cons of a trust is that, one, the ATO does not like it. So therefore they actually thinking of applying a new tax rule on trust. It hasn't happened yet, but there might be something that's going to happen in the next 5 to 10 years. They've been, scratching the surface with a new tax laws for trust. So just got to be very careful with trust right now. So it's not a long-term game. It could be a short-term game only. Also, a trust is actually more expensive than a company, especially if you're doing it from New South Wales, because you got to pay for stamp duty. You got to stamp a trust, whereas a company, you don't need to stamp it. And usually a trust comes with a trustee company, a corporate trustee, which means basically you're setting up a company as well as a trust together, and it costs double the price basically. Also, it could be seen as a pro, but to us accountants, especially me, I see it as a con, which is that a trust, the profits have to be passed over to a beneficiary or owner every single year. So if you're making like $1 million profit or $500,000 profit, a very high amount of profit every year, that profit needs to be given to someone. So if you pass that profits over to a beneficiary and you're the only beneficiary of the trust or the business, that means that you're going to have a very high income at every year, basically, from moving forward. So flexibility wise, it's good. You can distribute profits, but sometimes it's too good that, like, if there's profit that needs to be passed and it has to be passed, it's only going to go to you and you pay the highest tax. So that's the cons of a trust.
Okay.
Yeah.
Perfect. Now, the pros, we talk about distribution of profits. We've talked about, that within a family group. Can you just touch on that for us a little bit about the distribution of that to a family group?
Yeah, so the great thing about trusts, which is also what I said is a con, is that you can distribute profits to a family group at whatever you see fit. So one year you could say 100% goes to Davey Mack, and then next year 100% goes to Davey Mack's wife, if I have a wife. And then the next year after that, 100% can go to mum and dad. So that's the beauty of a trust. With a company, you can't do that. The company has a strict structure, which is, for example, in option 2 right now, there's 50% owned by individual 1, and then there's 50% owned by individual 2. So when you pass the profits, it has to be 50-50 because the structure is like that. It's just strict in that way. That's where option 4 comes in, which we call it kind of like a hybrid version of option 2 and 3, where we have a trust involved as well as a company, and where this counters the con that trust and companies have, basically, where you can't do it. It's a strict profit share that you have to have for a company, and in a trust you have to distribute the profits. In option 4, on the other hand, we're using a trading company to keep the profits in the company, and if you want to distribute profits and you don't want to do it 50-50, you can give the profits to the trust, and then the trust in the middle decide, okay, who do I give the profits to? Do I give it to the ultimate individual, or do I give it to their family members as well? So that's the beauty of having option 4. But you don't jump into option 4 straight away. There are times where you might start off with option 1, 2, or 3, and then option 4 is something that you go into at the end or later in your brokering business. Some clients go straight to option 4 because they know that they're going to be doing quite well.
Yeah, sure.
Yeah.
So look, before we move on to our next section, which I'm sure everyone's going to be really excited about, is just run through sort of that list of key things to consider when wanting to change your current structure.
The key things that you need to consider. Yeah. So, so the key things you need to consider is basically you don't go spending thousands of dollars modifying a rundown car with a bad engine, or an engine that you don't even know it's going to work. So one thing that you need to understand is that when you start a mortgage brokering business, you don't go spending thousands of dollars on a structure like option 4 if you don't know if the business is going to do that well yet. So we always say to our clients, it just depends on how you think the business is going to go. If you think it's going to be making $20,000, $50,000, maybe start off as sole trader option 1. If you're thinking you're going to be making about 100 to 150, then possibly, this is profit wise what I'm saying, maybe option 2. If you think you have a lot of beneficiaries and people that you can pass profits to, then option 3 is the best option for you. But you also want to consider, are you planning to sell the business as well? Because remember how I mentioned a company doesn't get the 50% CGT discount, whereas a trust or a sole trader does. So if you're planning to sell the loan book to someone one day, then maybe option 3 is the best idea for you.
Okay, perfect. So again, let's just put that into, I guess, a situation that our brokers might be in. They've just hit 150K in profit. They're currently operating as a sole trader. What are some of the things they need to be wary of or need to consider?
So let's see. So what you need to be wary of is, as a sole trader, is do you have any personal assets in your personal name? Because if you have a lot of personal assets in your personal name, like a house that's worth $1 million or $2 million, then it may be risky for you to have the business in your name as well as as well as your assets in your personal name. So that's one big no-no if you're worried about your personal assets being exposed. Then another thing is that your income. So are you turning over, or is your profit over $150,000 or 120K? Because if that's the case, then you're on the high tax rate, 37%, and possibly maybe even 45%. So keeping all the profits in your personal name, such as sole trader, is not the best idea for your situation.
Perfect. So that broker that is turning, has hit that 150K profit, they really need to be considering, an option 2 or an option 3 structure.
Yeah. And also, like, if you're planning to sell the business as well, one day, and that's going to happen in a year or 2 years' time, then maybe it's better to move over to option 3, which is a trust. So you can distribute the profits, because when you do sell the business, you're not going to sell it for $1 or anything. You're going to be probably selling it for a big amount of money you're expecting to. So you'll want to be able to access the small business CGT concessions. You will want to be able to access tax concessions for your business and for in the CGT discount. So as a result, you want to have a trust, because then you can distribute the profits not just in your name, but in family members' names that are maybe low income earners.
Yeah, perfect.
Cool.
Now, everyone, we will be also attaching a link to this document that Davey's provided us for you as well tomorrow in that email. So you will be able to download that and have a look at that tomorrow. Yeah. So really worth considering your options and talking to a trusted advisor. Or it may be that with the wonderful offer that Davey has put out in relation to this webinar about a one-on-one with the Fox advisory team, that this may be exactly what you may want to talk to them about.
Yeah. So I noticed there's a lot of questions that have been asked as well. So
yeah, there is. Yeah. And I think we'll just leave them all to the end, Davey. Okay, and we'll shorten up a little bit because we have got quite a few questions. So we'll shorten up the rest and then be able to address everyone's questions at the end.
Sounds great.
Now, this is the bit that I like. And again, if we're thinking about the expenses that we're going to be able to claim, for this financial year, I think it's really important for brokers to understand that, but also understand some of the nuances between working from home. So lots of us have been working from home this year and may continue to have to do so for a little bit longer. And we've obviously got that daily set rate and then actually keeping, your receipts and actually keeping a really good list, I guess, of your expenses. So talk about the difference between those two things, about the set government amount of 82 cents or whatever it is for work from home versus keeping all your receipts and keeping things in a tidy order.
Yeah, we always find that keeping all your receipts is usually a better way of claiming more tax deductions, because you always have more receipts and more expenses rather than the shortcut method that the ATO applies. The shortcut method is to include everyone. So it's like an average of all the expenses in a business. And usually it's just the bare minimum that you can claim. So the shortcut method that you're referring to is the 80 cents per hour working at home. So if you work, full-time at home, 40 hours a week, you do 40 hours times by 80 cents times by the amount of weeks that you worked at home. So if it's 52 weeks in a year, then 52 times 40 times 80 cents. And it works out to be quite a small amount. It's actually not a big tax deduction at all. So if you go 40 times 0.8 times 52, sorry, I have a trustee calculator here, but that's $1,600, $1,600 roughly. And that's not that much. When you think about it, yeah, you have rent at home, that a home office rent that you could be claiming. So you might have one bedroom in your office completely. So you can be claiming the rent on your business if you work specifically just at home. So there is this rule in the ATO that they basically state that if you don't have an office, commercial office, and you work from home and you have a bedroom that's dedicated for your office and for your business, you can claim a portion of your rent as a result of that, even though it's your personal home that you're renting. So, and how it works is you work out the square meterage of the office space, which is your bedroom, as opposed to the whole building space. So say that you've got 60 square meters of the whole building, and let's just say that 10 square meters is your bedroom that you're using for the office. Then you do 10 divided by 60, and that's your portion that you get to claim. So 10 divided by 60 is about 17%. You're going to claim 17% of your rent. And when you think about it, rent is quite expensive. If you live in Sydney, for example, your rent could be like $500 a week, right? $500 a week is $26,000. If you're claiming 17% of $26,000, that's about $4,000. That alone is more than the shortcut method.
Shortcut,
So,
yeah.
Yeah, it's insane.
And I don't know where you're living in Sydney, mate, if you're paying $500 a week.
Oh, well, like you're talking about like a 2-3 bedroom house. Oh, true. That's pretty cheap. Yeah. So those are the types of claim that you can have. But there's also other claims. You can claim telephone, internet on top as well. So from that $4,000, you can claim now your telephone and internet. You can claim travel expenses, meeting costs, software, commissions that you pay. One thing that a lot of brokers do pay is gifts. So if you're if you're buying a gift for a client, if you're buying vouchers for clients or referral partners, you can claim those expenses because it's seen as a form of advertising.
Okay.
And yeah, a lot of people don't think about that. And what I always say to our clients is that there's a lot of talk about, do I need an invoice? Do I need a receipt? What happens if this client that I've paid a $500 commission to doesn't have an ABN? How do I claim it? So I always say to our clients, look, that's a very gray area because the client doesn't actually have an ABN and you're technically supposed to get them to send you an invoice. What a better way of doing things is buying a voucher for $500 and gifting that voucher to them. It's still the same thing. That voucher is still usable. They can still use that $500 to do whatever they want. And as a result, now you can claim that gift and that voucher. Yeah.
Perfect. That's awesome. And what about super?
Super? Oh yeah, super is a good one as well. So if you're earning quite a fair bit of money and you're making a lot of profit in the business, your tax is quite high. Superannuation tax rate is 15%. So if you contribute up to now 27,500 into the super fund, this is including your 10% super that you have to pay. So just so you guys know, it's not 9.5% now. It's actually 10% starting from 1st of July. So if you contribute more into super, you can claim a tax deduction in your personal name or in the business, and the tax is a lot lower. So yeah, definitely. Super is definitely something that a lot of brokers do look at. But look, you got to understand that you can't access that money until you're 60, 65 and you're retiring. So it's still a long way for those young brokers out there. So some brokers may not want to contribute to super.
Perfect. Yeah. Now, I want to talk about how we stay on top of our bookkeeping and how do we stay on track. So when I had a consulting business a couple of years ago, from a personal experience, I was a shocker and had a shoebox that all my receipts went into, and then it would come to the end of the year and it would be a nightmare. End of financial year, it would be a nightmare. So give us the sort of your top tips around how you keep on track of your bookkeeping as a business owner.
Yeah,
especially I guess the sole traders where they may not be actually necessarily utilising the service of a bookkeeper during the year.
Yeah, I'll be honest, most mortgage brokers are notoriously not that great with bookkeeping, but then you got accountants like myself to take care of that for you guys. So let me be quick. I usually give about 6 steps. First step is to first see an accountant or a bookkeeper to ensure that you know what you're doing. So get them to advise you and train you up on how to do it. Maybe they need to set the accounting software up for you. Maybe they just need to set up the process and tell you exactly how to keep your records, how to do the bookkeeping, what software to use. And then step 2 is then get a good habit of keeping good records. So for me, it took me a while to get used to this is every time a receipt comes into my hand, I quickly grab my phone and I take a photo of it and I send it to Dropbox, and I keep everything in Dropbox in folders. And then I let my admin team manage the Dropbox folder and reorder it into a day order and name it properly. So that's just a good habit I have. And you need to get a good habit of that, because if you don't do that and you just chuck the receipt in the shoebox, you might forget to, and you leave it in your car, and then you end up chucking it out because you're cleaning your car up. So just have a good habit of just taking a photo straight away. Step 3 is get a good habit of checking your software and reconciling your software on a weekly basis at bare minimum. So not monthly, not quarterly, or not annually. You're crazy if it's annual, but weekly at minimum, because if you don't do it on a weekly basis, you're never going to know how much money you're making. You don't know how much money you're spending. And then you can make quick decisions that you need. Step 4 is get training if you haven't got training, or if you've got training at the start, then get someone to come in, and an accountant or a bookkeeper to review your accounting software. So I hate the case where a client spends 12 months of updating their bookkeeping and their software, and then 12 months later, they see an accountant and the accountant says you've done it all wrong. So they spent hours working on this accounting software and they've done it completely wrong. And then now they got to pay $1,000 to go and get everything fixed up. So it's always good to get a review or get some sort of training after you've set everything up, just to make sure that you're doing the right thing. And then step 5 is learning basic accounting and tax, which means, so you have to learn the basic knowledge of accounting and tax. I don't agree with business owners that say that I just want to hire an expert and I'll let the expert deal with it. Accounting and tax is something that you need to know. It's not something that you can just push away and never know about it, because the ones that fail in business are the ones that don't actually know that there is a lot of tax that needs to pay, and they don't account for it fast enough. So they spend money and they make decisions without even considering tax and how much liabilities they have, and then they make the worst decision for their business as a result. And the last and final step is to save and put away taxes, or at least know what your tax liability is on a given time. Like usually every quarter, you should at least know roughly how much tax you're going to be paying. And they're the steps. That's the steps of being a really good with your bookkeeping for your business.
Perfect. And I love that. And we certainly see as you know, our broker partners, and I've certainly seen it too, you know, we see some clients that, you know, have horrendous tax bills and really strong cash flow. And it's like, how do you guys not actually account for this? And you're right, it's all about spending and not necessarily taking into account your obligations. So because we have got a few questions, I want to be really quick. Can you just give us a quick reminder about that single touch payroll?
The single touch payroll? Yeah. Okay. So single touch payroll it's not what the name of the process is. It's actually not a single touch payroll where you just click a few buttons and that's it, your payroll is done. It's actually a complete disguise by the ATO. What it really is that now that you're doing payroll and you're doing pay slips for your employees and yourself, you're actually lodging that with the tax office on a regular basis. So back then, the tax office used to only know about your payroll once you've lodged your pay-as-you-go somewhere, so your group certificates. Now they want you to lodge that on a weekly, fortnightly, or monthly basis with the tax office, so they know if you're paying your super, if you're paying your wages, and if you're paying your taxes on time. That's what single touch payroll is. It's a lodgement program with the tax office is now encouraging businesses to let them know on a weekly, monthly, or fortnightly basis their payroll. That's what single touch payroll is. So people think that it's like an automatic, okay, you click a button, all your payroll is done. Your wages are going to be paid. Your super is going to be paid. It's actually not that at all. It's actually just a reporting standard. So it's similar to BAS's, but on a weekly, fortnightly, or monthly basis.
I love how we mask things that are sometimes complex with a really simple title or a really simple name. So thanks for just touching on that. I know we've mentioned it before, but certainly, you know, we obviously have a lot of brokerages that have, you know, a number of staff, and then we've obviously got our sole trader guys as well, but it's just important to touch on that.
Yep.
Now, we're going to conclude that really important piece of information. You know, we'll just touch on it again. We spoke about the Covert Grants, and you can find out some more information. We have got a couple of questions about that, Davey, so I'll touch on that. But Davey's doing a webinar on it tomorrow. Business structures, really important. You will get a copy of that document. And as I said, if you want to take advantage of the very generous offer that Davey and his team have given, that may be a particular topic that you may want to, you know, have a chat and take advantage of that one-on-one session. What type of expenses can I claim? Again, it's really important to understand. A lot of us think that we can just use that shortcut method, but you may actually be doing yourself out of, you know, greater benefits from the ATO by just thinking you can use the shortcut method. And then again, staying on top. So that may also be something that you know, may want to discuss with the team at Box around, you know, what sort of systems can you set up to make your life easier, to make, you know, then your expenses claims and running your business, you know, a lot more efficient, and certainly maybe more rewarding when it comes to the end of financial year. So there are our tips. Let's start with the questions. So probably more a statement. Definitely, again, there's some varying fees out there around setting up company structures. So just make sure that you definitely talk to your trusted advisor, or again to Davey if you're looking to do that structure, because we do know that it can vary from, you know, $600 and then sometimes I've seen people be charged, you know, $1,800, $2,000 to set it up. So definitely make sure you do your homework there.
Sounds good.
On the grant, the Covert grant side, Davey, we've got a really interesting question. And this is probably very relevant to a lot of our brokers. Do businesses outside the state, so outside of New South Wales, qualify if they have a lot of revenue from New South Wales clientele?
Yeah, so they don't, unfortunately. So you have to actually be registered and located in New South Wales. Service New South Wales would not recognize you. So therefore you won't be able to proceed with the application unless they change things, from what I hear now, but it doesn't look like you'll be qualifying for this grant. However, if you're based in Melbourne or Queensland, look, I feel like something's going to happen soon. We all know that like COVID's spreading really quick, and I know that the states are going to be looking at, like, you know, grants if there is a lockdown in your particular city. So Melbourne looks like there might be a lockdown there, and there probably will be a grant that's applicable for Melbourne businesses as well. But just so you know, we didn't touch base on it that much, but there is a COVID disaster grant with the federal government. So not state driven, it's actually with the federal government where you can apply for. However, it's through Centrelink. Some people are just against Centrelink because of long lines. But yeah, there is, I think it's up to about $600 a week that you can apply for.
And so, and what's the name of the actual news set? So we've got the COVID disaster, but what's the actual title for those that might want to do a bit of a search on it now of the new grants?
To be honest, it's just called COVID New South Wales Grant, a small business grant. Right now, there is no name. It's that early. People are just calling it so many different names. They're calling it a hybrid between JobKeeper and Cash Flow Boost. They're calling it Job Saver. There's a whole bunch of names for it, but right now the government actually hasn't called it anything but a New South Wales COVID-19 small business grant. That's what they're calling it. Yeah, cool.
Now, one of our brokers, Gary's asked a really interesting question, and he's after your thoughts on operating as a discretionary trading trust without a trustee company. So that being that the broker is the trustee.
Yeah, so it's actually a good common question that gets asked. I'm against it, and it's only because I've seen really, really bad worst case scenarios where an individual gets bankrupt, and because for another reason, and or they go through a divorce or anything like that, and they are a trustee of the family trust, and as a result, they get the whole family trust and its assets get tied or gets exposed to whatever dealings that the individual trustee has. Okay. So it's better to have a company, a trustee company, and if something happens to the director who is also the individual, we can boot the director out because it's not acting on behalf of the creditor, which is the trust. That's why we have a trustee company. If you speak to any lawyer, they will straight away say, nope, trustee company, because lawyers are there to protect you. Yeah.
Right. And why not have a bucket company?
Oh yeah, you can have a bucket company. it's definitely a good idea to have a bucket company. And the way the bucket company works is it's exactly this time around, it's exactly what it's called. It's there to keep all the profits and hold all the cash. So if something were to happen to the trading company, the brokering and it gets sued or something happens to it, then you have all the money in the bucket company, which is protected. I do see that mortgage brokers and commercial lenders and businesses that are in the finance industry, they don't get it's not as much risk as like, construction business. So therefore bucket companies are not a big thing, but investment trust, investing through a trust or investing through a company is something that a lot of lenders, finance companies do.
Okay.
Cool.
And Depan's asked us a question: if a broker's a sole trader and is worried about personal assets, however, they're not earning over 100K, would a company's structure still be a better model to consider?
Yeah, 100%. Because we've got like tradies, for example, that do the exact same thing. They don't even make a single dollar and they would set up a company. And the reason being is because there's just too much risk. And it just depends on your risk level. Do you feel like, oh, I've got these personal assets, I don't really want anyone to be exposed at all? Then you should be setting a company up. And it doesn't cost that much. It costs $1,000 for the company set up maximum. And then it costs about $2,000 to $3,000 in accounting fees. So it's not that much risk. But like I said, if you want to insure a car that's like that terminology that I'm using with a car, if the car is not that great, but you love it absolutely and you want to protect it, then you're going to insure it no matter what. Some people will insure the car, some people won't. So it just depends on the person and the business.
Yeah, perfect.
Yeah.
Now, distribution of profits. Great question. Can you distribute profits to your children when they're like 5 and 6 years old?
So you can. I think it was like $500 or something, $400. So you only can distribute up to that point, and then after that, any dollar over that amount, I think it was like 400, is taxed at 45%. So that's the real answer is no, you can't, because who the hell would distribute more than just $400 to a kid? So back in the day, however, 10 years ago, so when I first started in accounting, you could distribute to kids that were under 18 and access the small the tax rates and minimize the tax or in the tax-free threshold. But a few years into my accounting career, they removed that. And like I said, ATO and the government did not like trust, and they limiting the powers of a trust slowly, and eventually they're going to eventually trusts are not going to be as powerful as possible as what it was before. And right now, trusts are still useful in the sense of distributing profits in different individuals in different years. So you have the power to do that. Whereas a company, it's structured where you just have to give 50% to one shareholder and 50% to the other. But a trust is not useful in the sense that it can distribute to under 18 now. Yeah,
perfect.
Not anymore. Yeah.
Thank you. Now, I'm just about to hit the last question with Davey, and I appreciate we've gone a bit over time, and fortunately, most of you have been able to stay with us. But we spoke about being able to claim a portion of the rent. Can you claim a portion of your mortgage payment? Yeah,
you can, but it's a double-edged sword in this case, because if you claim your mortgage repayment, it means that your house is your principal place of residence is used for the business. So you get a tax deduction for it in your business, but when you come to sell the property you don't get the CGT exemption anymore because it's your home. It's your main residence. It's partly taxable now because you've used it for business. So part of it is not your main residence. So for example, let's go back to that example where we claim 17% of rent. So let's switch it and say that it's your home. So you get to claim 17% of your mortgage repayments, but not your mortgage repayments, it's your interest. So if you're interest only, then yes, it's just your mortgage repayments, but you only can get to claim 17% of your interest. And as a result of claiming 17%, now that when you sell your property and you make $1 million on the sale of the property, you have a capital gain. Usually it's exempt because it's your home, but now that you've used it for business, 17% of it will be taxable. So you have to pay tax on that $1 million profit of but 17% of it. So 170K, you have to pay tax on.
Wow.
Yeah.
I'm glad someone asked that question. That's
Yeah,
obviously quite important to know. Yeah, it is a double-edged sword.
Yeah.
So look, we don't seem to have had any more questions, Davey, while we've wrapped up. It's been great. It's been a really interactive team today on this call. So just to wrap up today, guys, please remember that tomorrow when you receive your email, you'll have a link to Davey's webinar if you'd like some more insights and information around the government grants. Also, you'll have a copy of Davey's company structure. And thirdly, don't forget this great partnership that we have with Box Advisory for those of you that have attended today, where you actually will be able to book that one-on-one session with the Box Advisory team to, you know, go through any questions or anything you may want to discuss further. It's a very generous offer, Davey, and we know we certainly asked you about, are you sure you want to do this time of the year? And you said yes. So look, we really do appreciate that. And we thank you again for giving up your time and especially for this one, you know, to really be able to give our brokers some great info that's going to support their business. And Phil's just said, you know, it was a really good presentation today. So I think there's been a lot of value. Davey Mack, as always, looking forward to next month. Stay safe in Sydney, and thanks again for all your time.
Thank you, guys. Thanks, Danielle. Appreciate it. See you guys
Thanks,
next
everyone.
time.
Have a great day. See ya.
Yeah.